You started. All right. Hi, I'm Lauren, and I'm doing question 1. So it asked me to calculate the initial lease liability and the right to use asset for a lease agreement. So the lease term was 3 years. It had annual payments that were paid in advance and a 9% implicit interest rate and a residual value guarantee of $3,000. So I used that information to determine the lease liability and then use that to calculate the right of lease right of asset. So my contribution included finding the lease liability. So I took the payments and which was $15,100, and from that I took away the $3,020, which were just maintenance and insurance costs, to calculate the lease liability. And also, so that was any unpaid lease payments, so just 2 years worth because the first one is paid in advance. And it also included the present value of the residual value guarantee of $3,000. So I calculated that and it equaled 23,567 and used that to calculate the right to use asset. So I use those ones then to construct a lease payment schedule over the 3 years, as well as the initial journal entries on the 30th of June 2024. So I did face a couple challenges answering these questions. So the first challenge I faced was the lease liability. Just calculating that, I found that there's a lot of hidden payments and it isn't just as straightforward as just the yearly installments. So I had to make sure that I didn't discount all 3 years of payments because the first one's prepaid. And I did find that a little bit difficult, but I used the textbook, which helped me figure out that the first one is prepaid, so it's already in its present value form. As well as that, I found a little bit of trouble just managing my time by myself. I did find I struggled a little bit with that, and I just found it a little bit confusing, but I triple checked and I used all the different resources given and any slideshows and everything like that to try and go through the information. I did find this question could be quite beneficial to people in their personal lives and their professional lives as well. So I learned that there's a lot of indirect or hidden costs relating to lease liabilities, and it isn't just the yearly payments, like I said. If people just in general wanted to learn how to lease an asset, I think this question and the calculations that I made could help them to budget their funds properly, display their lease obligations in a clear way so that they can see how much they have to pay when, and also to assist with their decision making and could help to decide if they should or should not make a purchase in general. So yeah.
Hi, Miss. I'm Harvey. Now I'll go through the question 2. The company purchased 3 machines on 15 July 2023 on credit. The bank asked for a yearly interest payment of 5%. So we have to record the interest payment at the end of the financial year, which is 15,000. After that, machine A, B, and C cost 35%, 40%, and 25% of the total amount of 300,000. So we have to debit those 3 machines according to their proportion and credit the account payable in the total of 300,000. These machines are depreciated using a straight line method, and their useful life are 10, 12, and 14 years respectively. Soon after the purchase, the company decided to keep this machine under the revaluation model. On the date, the company received the following information about the fair value. So machine A has a loss of revaluation of 10,000. Machine B has a gain of revaluation of 5,000, and machine C also has a 5,000 of gain on revaluation. After a few years, the fair value of this machine changed again. So before that, we have to depreciate the machine, but only from July to October because the revaluation start at October. After that, we start to record the new valuation. Machine A has 3,833 of loss revaluation. Machine B has 1,528 of loss of on revaluation, and machine C also has 20,095 of loss on revaluation. After that, there's a new revelation before the end of the financial year. So we also have to record the depreciation first. But now it's from November to 2023 to June 2024 only. We done the depreciation for July 2023 to October 2023 before. After that, we have to close the accumulated depreciation account. So we have to debit the accumulated depreciation of machine and credit the machine. Then we start to record a new revelation. Machine A has a loss on revelation about 7,123. Machine B also has a loss on revelation about 2,333. But machine C has 6,762 of gain on revelation. During the process of assignment, the only challenge is how should I depreciate the machine because there's a revelation in the middle of the financial year. I just go through the tutorial question we done before and check some relevant information from online to solve it. I'm using AASB 116 in this question because the machine is revalue PPE and is depreciated by using straight line method. So I use both cost model and revelation model to do the measurement. In the future, I'll make sure the PPE for my business is depreciated properly and do the revelation every year because the value of PPE will change every year. But I will only do it at the end of the financial year because it will simplify the calculation of the depreciation. That's all for my presentation. Thank you. Now I'll pass it to Alexis.
Yeah, so my name's Alexis. I did question 3. This question talks mostly about tax effect on accounting. So it was about the purchase of a machine from this company for $500,000. And the accounting depreciation had a useful life of 20 years and a residual amount of 50,000. However, for tax purposes, it was 15 years without a residual amount, and also includes some other events that happened in June of 2027, which included disposal costs. So to go through this, I went through 3 separate dates. So the 1st of April is the first part when the machine was acquired. So that was just the journal to recognize that the company has purchased the machine. 30th of June 2024 outlined the depreciation using the straight line method as mentioned in the question. And this was calculated using 3 months of depreciation with different amounts for the accounting and tax depreciation. From that, the tax effect can be determined by figuring out what the carrying amount is from the machine and accumulated depreciation. The future deductible amount turned out to be $491,666.67 to make the tax base. And this was less than the carrying amount, which created a taxable temporary difference where the adjustment entry was determined to be a deferred tax liability. For 2027, the 30th of June 2027, this added on 3 more years of depreciation, which decreased the carrying amount, and impairment loss was also calculated on top of this. So taking impairment loss out of the tax base and the carrying amount determined that the carrying amount was less than the tax base, creating a deductible temporary difference, which is then a deferred tax asset, which was then adjusted for as well. The most challenging thing from this question was differentiating between taxable profit and accounting profit, because the treatment is quite different and the actual dates were different. So putting them side by side became pretty difficult to work with, but working through examples from the textbook and the questions done in tutorials, I was able to work through that. Different carrying amounts were also difficult to work with just because they looked very similar and they're also the same date just on different years. But separating those was probably the key in working out those together as well. And also trying to determine where impairment loss was used in the question, and determining what this did to the machine in terms of taxation. But this was taken from the carrying amount to account for this and then calculated from there. As mentioned, I used chapter 13 of the textbook, which outlined the steps in the chapter to determine journal entries that were necessary for deferred tax. And then the opportunities from this question are most applicable to the taxation of accounting, where tax is different to accounting, where accounting may recognize it. However, tax accounting applies to all individuals and businesses because everyone is taxed on income. So it's crucial that we all have an understanding of this. Thank you.